Yeah, most of what I do is insurance-based financial planning. I work partner with Patrick Donho, Paradigm Life, and I started off there as a client 2011 when I was buying my first properties. That was even slightly before I met Jason and the whole turnkey approach, kind of trying to do it on my own with the first one. That didn't go well. And so I got a team behind me and I bought, we got in the end, less than 10 years later, we had 10 in my wife Susan's name, 10 in my name. I was repositioning money from the market. So it's, I didn't make all of that down payment at the time. And it worked tremendously well. And I will always keep single family homes. And that's my core. But along the way, I decided that I didn't want as much of my own money. I just wanted to get more efficient. I wanted less of my money in from a risk perspective, from an efficiency. I think everyone who's read Rich Dad, Poor Dad gets the concept that if you have none of your own money in the deal and it still cash flows, even $1, it's an infinite return. So I was kind of looking for both efficiency on my dollars and asset protection. And so I found this approach of storing my money in a different location. And so that made the biggest difference for me. And when I was 4 years into the process of real estate and focusing on personal finance, taking back control, that's a big thing for me, is having control of my finances. So this is just an example to remind us of the power of compound interest, really is it. So what I personally do is I store my money in a life insurance vehicle. Why do I do that? Because it's private and protected and it grows at, let's call it 5%. In this picture, I'm assuming 6%, but it grows without the impact of tax, right? And so there's a lot of benefits of why I store it there instead of a traditional savings account. But if you just store it in a traditional savings account, it still has a lot of the value associated with this. So rather than put the $50,000 into the down payment on, let's say, a duplex or a fourplex, if you have the money stored in a location where you can get a line of credit on it, then using somebody else's money, using 100% other people's money. So make sure my example is understood. $400,000 building, and I want to put 50. I have to put 50 in. And that 50 can either come out of my pocket and force my money to stop doing anything for the next 25 years, or I can borrow from somebody else, make them put their money into the property, and I can keep my money doing something useful. Mm-hmm. So if I have it in a savings account, I empty the savings account and then I pay the principal, if you will, to refill the 50 back into that savings account. Or I can leave mine in my alternative savings account and then borrow it from somebody else and repay them the principal as well. So the principal is kind of off the picture here. If you use 50, you got to pay it back somehow, right? Either into your own account or to somebody else. What I'm talking about is, what about that 50 and what does it do? So if I go buy a property and put my money in as a down payment, it's kind of like I go to closing at the house, I sign all the papers and they open the floorboard and there's this firebox down there. I stuff my down payment in the firebox and it's stuck until I sell the property, right? I just sold some properties in St. Louis. I finally got the down payment back from 10 years ago, right? So if I can borrow somebody else's money, two things are true. This is what the primary residence, 15-year mortgage guys that tell you to pay your residences off. They talk about half the story. One thing is true. On the top of this picture up there, if I borrow 50 grand from somebody and pay them back over 25 years at a 6% interest rate, which is a pretty high interest rate right now, I have to pay them as much, basically $47,000. So basically the same amount as the principal. And they will beat you with this fact all the time. Do you know if you buy a $300,000 house, you're going to pay almost $300,000 in interest? That's totally true. It's also one half the story, and in my opinion, not the important half, right? The other half of that story is I didn't lock my money up. If I can have my money grow for me and do something for me, and I know how to do at least 6% with it, then I get the compounding return on it. And so if I put my money in a savings account earning 6% with no taxes, it will turn into 215 over that same period of time. So to summarize this picture, I can pay 47 that everybody tells me not to do and make 165 on it. And to me, that's the value of not locking your money up and using other people's money when you can.
This is, a lot of this stuff we're talking about, because you alluded to it earlier, Gary, this is the concept of arbitrage. Yeah. Arbitrage is a cool sounding word, but I like to really simplify everything. And it just means taking advantage of or exploiting the differences in things. That's what it means to me. Okay. Like, people talk about derivatives. I call derivatives the thing about the thing, like it's just, you got to have this be more simple so we really get the impact of it. Right. And that's definitely true. So you want to arbitrage your money to make it work for you as much as possible. Okay. So tell us about this one, Gary.
So this is just simply, I just wanted to show an example. Some people you'll hear call this thing the and asset. I don't talk about it a lot like that, but really what it just means is that when you access the value of your money, you're doing it via line of credit, guaranteed line of credit from an insurance company. And that means that your money is not taken off the table. So when I borrow from my 401k, the money's on the sideline. It's not there anymore. When I borrow from somebody else or when I take money out of my checking account, it's not doing its previous job. In this case, it continues to sit in the background and doing what it was doing before, growing in a tax-free compounding environment, while I get the value of it by borrowing somebody else's money. That's all it really is intended to be. And I guess also it's pointing out the fact that you can use the money for whatever you want to use it for. It's your cash. Use it for a doodad, use it for an investment like I do, anything you want to do. Fund kids' college, that's a bad idea, but do it if you want.
Well, and the reason you say that is because college is a scam. and it wouldn't be a scam if it was reasonably priced and if they weren't brainwashing these kids. But since they are doing both of those things, it's a scam. So, yeah, absolutely. Good stuff. Good stuff. Okay. All right. Okay. So what about this one?
So you'll hear a lot of misconceptions. Not misconceptions. They're out of context. You'll hear people talk about you can't do what Gary's talking about. You can't get access to your money. I talked to my buddy and he said that you can't immediately access the money. So just to reiterate my story, when I learned about this approach, I was already in contract on my first property. I needed $80,000 for a down payment on this large new construction property. I said, stop. Put my life insurance policy in place, put the money there, and 3 days later, use those dollars or the value of those dollars to close on the property. So you can do it immediately. You can access a large portion of it from the very beginning. And so really, this picture is just intended to say that if somebody's saying you can't do it, they're talking about the beautiful, wonderful picture on the left-hand side, which is a normal old school life insurance policy. It's a great product. It's not a great bank, at least not early. And so we adjust it. So you need to make sure you just go to a specialist who understands how to optimize this to be both a bank and life insurance. That's really the point.
Okay.
I have a question for Gary.
Mm-hmm.
Gary, when it comes to, you were showing the example of taking out the loan from your whole life. How do those rates compare to like getting your conventional loan or portfolio lenders? Like right now, if I were to take money out of my whole life, kind of what rate roughly am I taking it out at?
Right. So I'm going to be Mr. English teacher for a moment because I think it's important to just kind of reiterate the approach. So you're actually borrowing money from the insurance company, leaving yours there and using it as collateral. Okay. Right? And so it's 5% as a floor for almost all of these insurance companies. And it can go up from there. It hasn't in over 10 years, but it is possible because they're really tied to Moody's long-term corporate loan rate, right? So what the insurance companies and the banks can earn if they lend the money out there. So you've always got first right of refusal. You can say, no, don't lend that to Caterpillar. I want to borrow it. And they would give it to you. You have a guaranteed access to it. But whatever the rate is out there that the money would have gotten, they're going to ask you for it. But again, it's been 5% for a long time, but 5% is kind of high right now. And so there's alternatives because every large banking institution in the country and the Federal Reserve, by the way, recognize this stuff as something called tier one capital assets. This in U.S. Treasuries, which I don't know how long U.S. Treasuries are going to hold that. But when the Fed lends money to major banks, they require them to have 20% of their money in tier one, which is life insurance on their executives or U.S. Treasuries, right? So they'll lend the money too. For example, I'm working personally with a bank that will give me 3.25% on 95% of my money. So you can go to another source as well. They see it as just good as gold kind of liquid asset. Does that answer it, Adam?
Yeah, so you can get 3.5, but you have to just go to outside source.
Yeah, and it's a little more restricted, meaning that you have to make a monthly interest-only payment on it from a normal line of credit like that. So from an insurance company, there's no requirement at all. One of those questions there about the cash flow, like, well, if I borrow from the insurance company, I'm 100% leveraged, I may not have any cash flow. Yes, but remember the control word. So if you're borrowing, using the money as the loan as your down payment, and you get tight on cash flow for some reason, just stop paying back that loan. Don't stop paying back the lender, the primary lender, but you can do it to the insurance company as long as you want, right? So there's a little bit difference there.
To the whole life, you were showing the chart that kind of talked about startup costs and how, but then the rest of it was liquid. What kind of startup costs are we talking about? So like if I had 40 grand and I wanted to buy a property, let's say I needed 40 grand for the down payment, what kind of money am I looking to put in initially to be able to pull out 40 grand a couple days later?
Yeah, so that each part of your first 2 years worth of contributions has a separate job. 80% approximately, 75% if you want to be super conservative, of the money going in is, you can think of it as money you're putting into your bank account. And that's the money that's liquid to be able to use. The other 20 to 25% has a different job. That money is held back by the insurance company for 1 year and then the second year. And they use the profits from that. They put it to work in the economy like they do the other money. And they use the profits from it to overcome their startup costs. There's a lot of people out there that will tell you, hey, well, the first year commission goes to the agent. Wouldn't that be awesome? And then the second year goes to the company's businesses, or expenses. That part's illiquid. So to answer your question, 20 to 25%, depending on how you design it, is not accessible.
Okay, so you need to put in like 50 grand in order to pull out 40 roughly?
Right.
Okay.